this video, I'm going to explain how they've been simply playing with your emotions all of this time. And I'm going to use the three major largest indexes to explain why. So a lot of people understand what we've been through in the course of the last 5 years. So just pay close attention to this. And we're going to talk about how the market and how the society has reacted during those times versus how they are acting now. So we want to start with COVID, of course. Of course, there was a major correction in the market. And actually, in hindsight, if you think about it, yes, it's major in terms of its percentage. If you were to kind of like go back to some of the previous times, like if I went down to 2009, this is coming out of the other major correction, the 2007 housing market crash. That's this guy right here. And you can see this one is pretty steep and it exceeded. So this was an actual recession. Okay. So we'll help people out with a little bit of visual representation. So this is that morning that we woke up in October 2007. Okay, very important. So let's take a walk down memory lane. Okay, where you had this, you had the highs. We're looking at the SPY. You had the highs in July, and then you get the retest. Okay, we're going to talk a little bit of structure, a little bit of market analysis here. So then you get the retest in October. Everybody remembers that fateful day when we woke up and we saw that the market had that pretty tough correction. So from the previous lows, it wasn't that steep. It only ended up getting steep and exceeding the previous low. So watch this, the previous structure right here, right? So this will help you guys understand at what point have you reached a recession, okay? And why this was like one of the major ones, but the one we even had in COVID did not even reach the point of a recession. So let's just look at it real fast. If I look at the low to the high before we got the correction, let's do it like this. This entire thing, this is what a recession looks like. So the good thing about it is now you know what a recession looks like, okay? Where you will exceed and break and close beyond in the market the previous lows. Now, the morning that we're talking about is this big one right here. Okay, so October 8th running through, let's just run through this week here through, November 19th. Let's give it a few weeks when we're just getting into it. Okay, I don't think companies really had to start making decisions there. Maybe getting closer to halfway through, but let's just measure it. Okay, Fibonacci is going to be very important for this conversation. So from the low here before the correction or the crash or the recession happened, okay, let's focus on that part. And I'm just going to use a couple of the major percentages. We'll look at 38% because we'll get a chance to talk about what these actually look like and what they mean and how the market reacts at these levels. So 38%, 50%, pretty steep. That's half of it. 618, the golden ratio, in which you're likely to either recover off of that if you hit that level, or if you break and close beyond that 618, what can happen. And the very extreme or deep 786 to 786 or 78% on the correction side. So with that being said, from the low here to the high, and then the recession starts. This is October 2007. You hit, here's what happened. Remember the numbers that I'm talking about. You hit 38%. Okay, that was kind of like your first chance at light. Okay, first chance to make it out of there. Is there support there to keep the market up? Absolutely, there is support in that area, okay? But it doesn't hold, just slightly, okay? Just slightly, okay? As you can see the support hold, okay? Because it's there, you see it here, it works. Retest, come back to that area. Another thing I want to point out, why we're here is in terms of making projections. When the market was falling, okay, investors and people of the like should have already known where price was going. They should have known, okay, that you were going to get at least a 38% retracement or correction, and then you should have found support there. That's evident to see now that we go back, okay. The problem is when the market came back to that area, it didn't hold and you get the crash. Okay, very important to really understand these things visually, because I'm pretty sure nobody talked about them and broke them down to you in this fashion as I'm doing right here in simplicity. Okay, so there you go. You get the recession, and again, you get the recession because you broke and closed below the market. Okay, so that's what happens when you're in bad shape. Now, this is where you had lots and lots of people laid off. This is when you had to have things like what is it called when the government comes and gives out money and stuff like that, and bank bailouts and things to that degree. Okay, now let's move forward to the next one. Of course, I did want to say, like the market always does, it rallied out of that. About 2 years later, that was pretty long. People were literally out of work for 2 years. I remember that time. Luckily, I was fortunate and I wasn't really impacted by that recession. And there was a little bit, slightly. But anyway, yeah, a lot of people lost their houses. A lot of bad stuff happened in that. Okay, I'm not gonna downplay that all. It's pretty bad. But my point is how strong the market rallied out of that, because that's what it's been doing the entire time. Okay, this is post 2000. After that recession, look what happened. Look how the market recovered. So we want to come and talk about the next major one. Okay, so we're coming into February of 20. That's when it started. And of course, we all know that's COVID. Okay, COVID was a very, very major correction. And you got to look at it. The entire world, meaning all the markets were shut down. And even in COVID, technically, yes, I'm going to say this. Technically, you had no recession. You had the same look of the market structure, the same thing we showed back in 2007. They're playing on your emotions, people. The same look of where you had that structure. You had that rally out of that. This is 2016. We know that was a pretty good time. You had that rally out of that, and then boom, you get COVID. Okay, 4 years later, you get COVID. Now, remember, we want to talk about the degree of the correction again. Okay. No, mind you, nobody wanted to talk about the one before that in 2018. I should go do the market research and actually go pull up those facts. What happened here from September 2018 through December? So that was a bad fourth quarter, probably something rate related. I can find it later, but let's focus on COVID. Remember me talking about the 618, okay, and what can happen when you recover out of a 618 retracement. Let me show you what that looks like. So let's just grab the fib again. Let's just go to the low again, where that run, the 2016 run began at, and let's go to the top and to where the crash actually happened. And if you look, remember what I said, you can recover very, very strongly out of the 618 golden ratio, which is what happened. Now, this one was steep, but remember, we did not exceed 786, which I said was on the extreme end, because now you're pushing 80% of the money coming off the table. We're at 78%, you're right at 80. And then because after 786, your next major support level is 886. So 786, 886, and then 100. Once you exceed 100, you're completely crushed and you have exceeded, creating a lower load than the previous lows. Okay. But this one here was even though COVID was very, very bad, the markets came to a halt. Okay. And COVID, this is February of 20, and then coming out of that in March. So really, as soon as I don't remember exactly if the markets had opened back up in March. Some things I remember at the time I did go back to work in March. We were out for we never stopped. We went and started working from home, but some of the other activities picked up. And my professional career picked up, and we actually started going back into the casinos and doing system upgrades and replacing equipment and doing all the things that we needed to do because everything was closed. There were no customers. You know, the resorts were closed, all of them. So imagine Las Vegas Boulevard with no lights and no people on the strip. It's like a ghost town. It was the craziest thing I've ever seen. But remember, that was a 618 correction. Okay. And look what happens to a market at the golden ratio. Okay, so you had the 2018 was, I can tell you, it's a 38% correction. You come back in COVID and you get a 61% correction. Okay, the market rallies even out of COVID. Now, I've been telling people that no matter what, even if you get the correction, all that does is throw the market off and spin it up into a higher high after it. You know, it's trending. This is the markets have been trending. And to this point, there is nothing to suggest that they won't. We'll get to that more on that in a second. Okay, something here. Now, here's what prompted me to want to make this video. And that was the most recent correction. the 2002 rate hikes was a very, very bad time for the economy. In the 2022 rate hikes going into 2023, little do we remember that the interest rates on homes and mortgages exceeded 9%. And people should remember how fast, because they were doing 25%, 50, 0.25, 0.50 each time. And they were doing that several times throughout the year. And nobody talks about the pain that we felt in 2022 as almost everything. Okay, I'll put it like this. The mortgage rates are still high. We're still working on those till this day. Nobody wants to talk about that. That started in 2022. The high rates that we're paying on our automobiles right now to this day, because we never see those rates again that we used to pay on autos. 15%. 17%, 18. Now everything that you see is very high. 20, 21, 25, and especially if you got bad credit, they're gonna kill you. They're gonna basically make it impossible for you to buy a car, just like it was almost impossible for anybody to buy a house, because nobody wanted to pay 9%. Nobody wanted to pay 8%. Nobody wants to talk about why real estate sales have been down and slowing since 2022. But I'll be the first to come say it. Now, let's talk about the levels, okay? I'm going to clean up the other stuff because we don't need it anymore, and we're going to focus on the next two. So, like I said, this is what prompted me to want to do this video. We've seen this before. And again, what happened? This is how powerful, this is how much money is flowing through the U.S. economy, okay? Even with rates as high as 9.1%. Okay, that was the super inflationary period. The market still rallied to the highs that we have right now. Okay, exceeded and closed beyond those right now. So I don't think that I'm even going to have to use the other indexes. I might take a peek at them because I think you guys kind of get the gist. They've been playing on your emotions. And again, there was none of the reaction right now. Right now, you didn't even have the type of reaction that you had in 2008, something that I consider far worse. There isn't a job issue right now. People can buy right now because I think the mortgage rates are somewhere around 6%. Maybe they came under for the first time since 2022. But in that case, before the 2022, that correction was 50%. So we will try to bring this one all the way home. That correction was 50%. That's pretty steep, a little, but not as bad as a 618 correction, right? So it was bad, but it wasn't as bad as a 618. You see the bounce off the 50%. You didn't even get close to the 618, and you rallied to new highs. Right now, the one that we're in, this is just a correction, just like that one. And they're playing on people's emotions, making you, put all the fear mongering and all the doom and gloom and creating all this uncertainty. And I can tell you, people, we are not even close to it. We're exactly in the same place as we were in 2022 with that 50% correction. Right now, from rallying out of 2022, out of that, right now we have just done a 50% correction, just wicking down. You can see the wick. We haven't even really touched 50 yet. And looking at it, the market, at least on the SPY, the S&P 500 was at 504. It's at 517 pre-market at the time that I'm making this video. Okay, so they're just playing on your emotions, and as you can see visually and historically, the market will respond and rally out of these things no matter what. The only time that it is a problem, and you will even recover from that, is if there is a recession. Okay, the economy is doing too well. There is not a crash. There isn't a bubble burst like there was back in 2007 that was caused by a completely different set of reasons. That was a crash. That was reasons in terms of policy, yes, but that was different. That was the loosening and the removing of all the policy and requirements for lending, and it basically allowed any and everyone. It was based on regulations. Remove the regulations from buying houses and giving loans and lending. And then, of course, you have the average person owning 3 or 4 homes that can't afford to pay for them. And once a certain amount of those loans were defaulted on, of course, the primary market, your major banks, your Wells Fargo, your Bank of America, your Citibanks, and the ones that are dead at the time that died off in 2007, sold those loans to the secondary market, Freddie Mae, Freddie Mac, those guys. And the condition that they set on those in order for the secondary market to buy those loans is that if a certain percentage of default, we're selling them all back to you. And if we sell you all these loans, that's going to crush and crash the market, which is exactly what happened. The threshold was exceeded in the amount of loans that could default off. I can't think of what the percentage is, but once that percentage was breached, the secondary market started selling those loans back to the primary market, and it crushed the market. Just a little bit of history for you to think about. But again, this is perfectly fine. This is perfectly normal. A little bit of pain. It's like there was a lot of pain dealing with any type of investing back in 2022. And here's the thing: nobody talked about the fall here every day. Okay, so let me just ask a question. If right now your 401k has been wiped out, yes, your 401k has taken a hit, but I see a lot of doom and gloom out there and a lot of fear mongering. That people want to shake and move and reposition and stuff like that. When it visually, you don't have to do that. You're going to be fine. But you didn't hear anybody talking about what's happening to their 401k in 2022. You really didn't. And the market lost as much, if not more, than it has right now with this same exact thing, to be honest with you. It's the same thing. You see it in front of you. Okay. You also see that it is oversold as it was here. Okay. As it was here, oversold on the RSI. You're extremely oversold, probably because RSI is a speed indicator. It's measuring the speed. This one is kind of fast. That's why. So this took several. This took a little bit over a year. January 22, coming out, recovering June. So 6 months versus this one started in February to where we're at, April. So 2 months, 3 months versus 6. But we can expect that this is going to be short term, and that's a lot of speed in there short term. And then, of course, I'll end it by saying rallying up out of this area, all of this crash and breaking below all this stuff, probably not going to happen. I will say that based on the levels, that even if the market did drop some more, which to be honest with you, I do anticipate more. I don't think that we're at the end of it yet. Maybe the 618. Okay. So on the SPY, and that would drop the SPY into 449. People are going to panic, but I'm telling you, people, the market's going to recover, come out of that, go back to where it was in February of 25 and beyond. Why? Because that's how the market works. We can actually get a little closer and talk about where we can see the market. This is where the real money is going to be made, because you see it ebbs and flows. Like if we were to take the previous run, okay, and clone it, right? If we were to use A to B is equal to CD action, if A to B is equal to C and D, that's what you got. I want to say one more thing while we're here. This would be the D completion, right, of that. Okay, that would have completed the A to B is equal to CD pattern. And here's the good news. We might not, okay, this market correction was going to happen anyway. Okay, let me do something real fast. Let me clean that up. I'm glad I came back around to remember that. That was one of the most important points in this video. And then maybe we'll take a peek at a couple of the other indexes. Okay, so this was the A to B is equal to C and D pattern. You saw me clone the A and B leg and put it on C. You saw me do that. Okay, so basically we had just completed this pattern, and this was going to happen anyway. You're going to get anywhere from a 38% to a 61% correction no matter what. So Donald Trump didn't have to get elected. He didn't have to do any tariffs. There was going to be a natural reason, natural phenomenon why this was going to happen anyway. I could sit here all day for the next 2 weeks and I could show you this happening. Literally, I can show you this happening 10,000 times. You can mark my word on it. You were going to be overbought at that point anyway. Look, February, look down here. Look at the RSI. Look at the RSI. We're way back here. We were overbought. Look at where the cursor is. Okay. So the market had been overbought all the way through. Okay. At this point, the correction had already started. Okay. When we get to D, the divergence was already there. This had already been taking place. In essence, yes, you can say that this correction was not even caused by the tariffs. Yes, sped up and a little bit more activated by, absolutely. But this was going to happen anyway, okay? Because the market corrects. Just like when it got here, you got a correction down to 50%. You come up here to the top, correction to 50%. You're going to come up here and create a new high. So my thing is, they're playing on your emotions. They're using all these things that are happening in the world of politics to create a frenzy and to drive narratives and things of that sort. But people, you're going to be fine. We're going to come up out of this. It's not as bad as they're making it appear. One more thing, I could do the same thing. These are just the three majors. The Dow Jones. I think there's the same stuff. We can see COVID right here in February 20. I talked about they're all going to say the same thing. They're all going to show and display the same thing. You have the structure, you break out, you come down 61, 70%. You go rally out of that, get a new high, you get 38%, right? 38% is the 2022 rate hikes that I was talking about that drove interest rates up to 9%, right? And what did I say? Even as bad as that was, yes, the correction was only 38%. We're going to go ahead and finish this up and get up out of here. And then you rally up out of that to where we are now. And then the DJI, watch this, DJI is really only about 38%. So they are really, and it's really just, this one might be over. Who knows? I can't say that. Let me not go too far myself, but really only in the 38%. Just wick down. And this is just a price action. This is just testing a wick into it. So you do get a close, the thick close, and it is what we call that an elephant candle, and engulfing. It is a bearish engulfing candle. Could be worse. I've seen worse. And then you come follow through with one more. But this one is decisionary. This is a doji. This actually symbols a change in direction, meaning it could go both ways. This is actually good for that to even happen that quick. So this might have been something that just lasted for a week, maybe two. Actually, not really. The fall actually started, like I said, November. So you get a retest of it. Cannot exceed, break and close and keep going. And of course, yes, you do get your elections and things like that. And you get a correction at the beginning of it. I'm pretty sure that if I were to go back to 2016, there's probably another one. If I were to go to 2016, 2016 to 2020, it's probably another one. What's this right here? Nope, it's 7. Just looking for it. 2016. Where's 2016 at? 18. So no, there really isn't. Okay, cool. So got that part taken care of. I think you guys kind of get the gist of what happens as the market is ebbing and flowing, and even when we're going through extreme things happening in our economies, you can see the market ebbing and flowing. And again, if I were to clone this and say A to B is equal to C and D, you're going to get the same thing, and it was going to be completely exhausted at D, and you're going to get a correction. So they're just simply playing on your emotions. NASDAQ, same thing. I do have this one actually written out for you already. Who is this? Coming out of COVID. That's amazing. This is March of 20, after everybody had got sent home and all that kind of stuff. Of course, there was a lot of money that went into the market, and then, of course, they pulled it back. They raised the rates and went and got it back. Okay, that's the Fed rate hike in 2022. Starting in this point, like I said, late. It was like November. It was very, very late, November 21, and then running all the way through almost a whole year to October 22. No one said a thing, and you can see it was bad. Okay, it's deeper and steeper than the one right here. Now, this is actually steeper, but it lasted longer. Of course, we're just getting started. That'd be, if we went a year with this, we'd be pretty bad. But I did want to say, even in the midst of all that, last week was a bullish week. Okay, and again, just one more time, the correction on the NASDAQ NDX, the correction is probably only 38%, right? Yeah, 38% red, right? Wick down into it, boom, then you got a green candle. Okay. Of course, it's going to be oversold on RSI. I don't know why my RSI is not showing, but should come out of this. So people, just relax. You're going to be fine. There's really not a reason to be concerned until the market breaches the 618 and maybe closes beyond this guy right here, at least on the NASDAQ, closing beyond the 618, something like that. Okay. That's when you would have something to worry about. So just say no to doom and gloom. Just understand, really, okay, that I showed you they are simply playing on your emotions. And you got to relax. The market's going to recover. It's going to be okay. It's not the end of the world. You're not going to lose all of your 401k. You're not going to get laid off. And you probably, so the inflation issue has not been resolved. So you listen, until everything's put back in order, you can't even talk about inflation, because everything is the same inflation that we had that was caused in 2022 is the same inflation we're dealing with right now. So continue to do what you do. Take advantage of this moment from an investing perspective. Find things that are cheap and affordable that you can buy and stack up your basket, because you see what's going to happen. There's only a few of these opportunities, right? And this might be one of them. This might be one of the biggest opportunities for you to do things like make a little bit more money, maybe even possibly secure your future. Okay. That's all I got on this one. Hope I'm bringing some value to you. If you like it, give it a thumbs up. If you got some people around you that have been asking questions or having conversations about stuff like this, share the video and send them this video. This will break everything down to them. And if you're not subscribed to the channel, please subscribe. I could really appreciate your support as we work to grow out this channel and continue to provide as much value as we can to the community. That being said, you guys be good. Take care of yourself, and I'll see you on the next one.